We think bonds probably play sort of three types of roles when you're building a portfolio. So when you think of it from a perspective of really diversification and defensiveness, you can use government bonds or potentially inflation-linked bonds, especially if you've got a portfolio that's heavy in equities. Again, talking to that point around barbelling, you're heavy in equities, you're heavy in risk assets, that's going to really act as your ballast and that defensive part of your portfolio. If you're looking for more capital preservation in Australia, we know you've got access to cash, there's also cash ETFs available. That's just going to really make sure that your position in your portfolio is going to stay the same. The third really big part around what fixed income is all about is the income part. And there is obviously opportunities in things like corporate or a more core composite type of structure that you can utilise in your portfolio to get access to that. So these are the sort of what we consider as we call the bond pyramid. So they're the three pillars that hold up a portfolio when you think about the fixed income part of that portfolio. I think a sweet spot's always hard in that every investor is different. Whether you're an institutional investor running a super fund, whether you're running a self-managed super fund, your investment is there's never going to be a sweet spot. Also, you're probably rebalancing all the time. The point we're referencing around the government bonds at this point in time not acting as a ballast stands up in regard of a global perspective when you've got negative yields and when you've got a market that has rallied significantly, as we've seen over the last 3 months. The correlation between the government bond being at the lower bounds of their capacity to rally, there's no question that they can continue to go negative, but it's at their lower bounds. In a shock move, they may not act as that ballast again. Where we come back to is there a chance that when this current deflationary environment changes and shifts with the governments putting all their policy power behind them, fiscal and monetary, to drive up inflation, there is a potential that it overshoots. If that is the case, then an inflation-linked bond may sit really well in a portfolio to take that risk out of the portfolio. So not to say that government bonds aren't suitable, but having a range of fixed income in a portfolio is vital, whether it's across credit, whether it's across government or something like inflation-linked bonds, to really buffer your portfolio, which is the point of where fixed income sits. Look, well, certainly this is not our base case. It is a bear case and something that we think is certainly worth monitoring, in that with this coordinated monetary policy and fiscal policy, there is a chance that there is basically a blowout. There's a larger deficit than the market may expect. And one of the ways to solve that deficit problem is to inflate your way out of it. So there is chance, and we've heard some of the central banks talk about it, that inflation may overshoot. And in a case of inflation overshooting, there is opportunities to utilise tools such as inflation-linked bonds as part of your portfolio.